are in listen-only mode.
Good afternoon, everybody, and welcome to our webinar this lunchtime. I'm joined today by my colleague, John Bailey. My name is Alex Peel, and I'm a partner in our audit and assurance team, and John is a senior manager in the same team. Before I get going, if at any time you have any technical issues or you can't hear, then please, if you write a question in the question box, we'll look into that and try and help you out. The agenda today then is looking at the changes to UK accounting, but sort of focusing on the requirements of small companies. Some of you may be aware that a few weeks ago we presented a webinar on the changes to company accounting, but focusing on medium and large companies, but there are also some quite significant changes for small companies as well. And for small companies, it's actually a bit more complicated because there are a number of different changes over the next couple of years and also a number of different options. So on the agenda, you can see the future of the FRISI, or the Financial Reporting Standard for Smaller Entities, something called FRS 102, that's Financial Reporting Standard 102. We're going to look at some of the tax implications of the various changes. We're going to look at something called the new micro companies regime and what that is and when you might want to use that. And we're going to touch on implementing the changes. Probably speak for somewhere between half an hour and 40 minutes, and at the end there may well be time for some questions. So if you do have any questions, do ask those as we go along, and we'll pick up on some of those as we get to the end. So moving on then, the future of the financial reporting standard for smaller entities. Now at the moment, very brief summary of where we are. At the moment we have effectively two sets of UK accounting, one for small companies and one for companies which are not small. Many small companies use this standard, which is a standalone accounting standard in its own right, often called the FRISI, but as I said, it's the Financial Reporting Standard for Smaller Entities. Over the last few years, there's been quite a bit of debate about the Financial Reporting Standard for Smaller Entities and whether it should continue or not continue. But the outcome of that effectively is that it is now stopping after the end of next year. And after that, all companies will be required to use the other financial reporting standards in existence, albeit with some disclosure exemptions, or they'll be able to use this micro entities standard, which we've talked about. Other entities like charities will still have their own specific accounting standards. So what is FRS 102 then? FRS 102 is a fundamental rewrite of UK GAAP. It's bringing our own accounting in the UK in line with IFRS, and there's a lot of abbreviations today, apologies for that. IFRS is the International Financial Reporting Standard. FRS 102 replaces all existing current UK GAAP, and GAAP, another abbreviation for those of you who aren't familiar with it, is effectively UK accounting standards. So FRS 102 replaces all UK GAAP unless you're using IFRS. And as I've mentioned, it also impacts most small companies, and there are a number of disclosure exemptions. As I said, we'll come on to what a micro-organisation or a micro company is. Micro-organisations can use something called FRS 105. So if we just touch on the sort of what is a small company for a minute. Over the years, there have been various thresholds to define what is a small company. Currently, it's a company effectively with a turnover of around £6.5 million, about 50 employees, and gross assets of about 3.2 million. So companies which are smaller than those thresholds are broadly what is currently defined as smaller companies. From 1st of January next year, those limits are increasing quite significantly. And for example, the turnover threshold goes up to £10.2 million and the gross asset threshold goes up to £5.1 million and the employee numbers stays at 50. So where are we then? We'll look at the accounting regime for small companies over the next few years. So companies which currently qualify as small are able to use the new FRISI, the new financial reporting standard for smaller entities in 2015. Now the new FRISI has very few changes to the old one, and they're so small, those changes, that we're not going to look at those at all today. Thereafter, companies are required to move to FRS 102, albeit with reduced disclosure requirements. As I've mentioned, if you qualify as a micro entity, you could use FRS 105 to prepare your accounts. And as I've also mentioned, there is no financial reporting standard for smaller entities from 2016 onwards. So when will you be affected then? So as I mentioned, FRISI 2015 applies to accounting periods beginning on or after the 1st of January 2015, and that we're already into that. As I mentioned, it doesn't change very much at all. FRS 102 comes in from periods beginning on or after the 1st of January 2016. So you'll see in the table down there some common year ends. So for example, if you've got a December year end and you run 12 months worth of accounts, your first period affected will be 31st of December 2016. If you've got a March year end, then you'll have until 31st of March 2017 to start implementing this. We'll come back in a minute to what transition dates are, but the transition date is effectively 2 years prior to your first year end, and it does have some significance in terms of when you have to apply the new rules from. Okay, so we thought we'd break up today a little bit by asking a couple of questions. They're not particularly difficult, but just to keep everybody's attention. We've got a couple of these questions. So the first one is, with the change to FRS 102, and this perhaps implies some prior knowledge, with the change to FRS 102, are you expecting profits to increase, decrease, stay the same, or don't know? So we'll just have a couple of 10 seconds or so for you to hopefully answer that question. Are you expecting profits to increase, decrease, stay the same, or don't know? And what we're going to do is rerun this question at the end, and hopefully the don't knows will at least have more idea about what might be happening. So I think most people have voted there. There's a few more coming in. A few more seconds. That's that. Okay, so no one expects profits to increase. That's interesting. 17% think profits will decrease. 44% think they'll stay the same, and 39% don't know. Okay, so that's our challenge then for the next half an hour or so, is to get that don't know percentage down slightly. Okay, so now we're going to move on to the detail of some of these changes and the key changes under FRS 102. There are actually some significant differences, and as we've talked about, they could affect your reported profits. Obviously, if your profits are affected, that could then have an impact on things like tax payable, bank covenants, the ability to pay dividends out. As well as the changes to the numbers reported, there are also a number of changes coming through to the format and the content of the accounts. So what goes into the actual accounts and what they look like. So if we go straight on then to some of the actual changes which you may experience depending on your company under the new rules. and this is under the new FRS 102 rules. The first area relates to goodwill and business combinations. Now, looking at goodwill, in the past, our clients have probably divided into two fairly distinct camps. We had a number of clients who would write off goodwill over a very short period, and we had a number of clients who would write that goodwill off over a much longer period, probably 20 years in many cases, which for some time has been sort of the default if you didn't know how long your goodwill might last. And the reason why some people wrote it off over a much shorter period was because they got tax relief for it. Under the new rules then, the assumption changes. So whereas in the past it's been that you had 20 years as the default if you didn't really have any evidence to the contrary, the new default period is 10 years. So unless you have evidence going forward that your goodwill will last for a different amount of time, the assumption will be that you'll now use the 10-year period as the amortization period for your goodwill. I'll come on to the next point in a minute. Under FRS 2, more intangible assets will be recognised. The contrast with IFRS is that under IFRS, you don't actually amortise goodwill at all. So interestingly, under the new UK rules, we're reducing the period of time, whereas under international financial reporting, there is no period, and you just review the balance each year to make sure that it's not been impaired. So I did mention at the start that we were actually coming in line with international accounting. This is an area where we're actually becoming more different, if you like. So that's the first key change, and obviously that will only affect you if you have goodwill or have goodwill in the future. Moving forward, moving on to the next area is business combinations. And as I mentioned on the previous slide, there will be in future more recognition of separate intangibles. Business combinations are purely where one company acquires another company and you prepare group accounts, which include the results of both the parent company or the holding company and its subsidiary. In the past, what's tended to happen has been that the difference between the amount paid for a company and the net assets that have been acquired, that difference has been put to goodwill on the balance sheet without too much additional thought. What the new standard says is that where you buy a company, you have to look in far more detail at the separate intangibles that come with that company, and that's not been done in the past. So things like customer lists, intellectual property, and other sorts of intangibles that many companies have, you'll need to separately identify in the future and split those out within the company's accounts. That will obviously lead to more work, and when acquisitions happen, we and you will need to look in far more detail at what it is that has actually been acquired. The good news with this is that you don't need to go back and look at previous acquisitions unless they've happened within the transition period. Now, I mentioned the transition period earlier, and this is one case where it is relevant. So if you've made an acquisition within the 2 years leading up to your first FRS 102 set of accounts, then you will need to have a look at that. If it happened, say, 5 years ago, then you don't need to worry about it. Okay, so that's all I want to say about business combinations for now. I'm going to hand over to John, who's going to take us through some more of the differences.
Okay, thanks, Alex. The first thing that I would like to talk about is lease incentives. The most commonly seen lease incentive is a rent-free period offered as a sort of incentive to sign that lease. Now, previously under the old Frizzy rules, this benefit would get spread over the period to the first break in that lease. Whereas now, we're going to spread this benefit over the full term unless you're expecting that a break is going to be exercised. Luckily, there are some exemptions to this. If the lease is in place again at your transition date, you can carry on before as if you're still applying the frizzy. I think the key thing here is to consider the treatment of new leases after your transition date. I think we could start to see some impact on profit. I'm going to give you a brief example of this. If, for example, you had a lease where you had £50,000 rent due per year and you were given 1 year rent free at the beginning with a 5-year break clause, previously you would have accounted for that £10,000 per year over the first 5 years of the lease. Whereas under FRS 102, you're going to account for that £5,000 per annum over the 10-year life of the lease. What this is going to result in is an increase in profit each year for the first 5 years, and then a decrease in profit for the last 5 years of the lease. The second thing is holiday pay. Previously, there's been no requirement to account for holiday pay or holiday benefits that have been accrued but not used at a year end. FRS 102 specifically states that you must account for this unused holiday. I think that the main issue that's going to be here is that if you've got a significant number of employees and high staff costs and your holiday year doesn't necessarily match your financial year end, you may end up with a large accrual. The impact of this is going to be that in the first year or on the transition to FRS 102, that this reduces your profits. And I think the sort of most difficult thing here for a lot of our small companies is going to be the quality of the record keeping. So there'll be a requirement to go back to the transition date and calculate what this accrual might have been or would have been at this point. Now, this accrual is going to be the number of days holiday that someone has accrued but not yet taken at that period of time, multiplied by their daily rate. Unless your holiday records are very good, it may be difficult to go back and calculate that. So the earlier you can start thinking about that, the better. Investment properties is probably one of the areas that has seen a larger change than others. There's a slight widening of the definition, mainly to include properties that are owned by other group companies and rented to another group company. Previously, there was no requirement for this to be treated as an investment property, whereas now it will need to be. Now, previously under the frizzy, you had to value investment properties at their market value at the balance sheet date. This hasn't really changed. You now need to account for them at fair value, which I think in most cases will be equivalent to the current market value of that property. Previously, these sort of changes in market value every year would have gone straight through the reserve section of the accounts, whereas now we're going to see them go directly through the profit and loss account. Now, this could bring some quite considerable volatility into profits, and their consideration needs to be taken as to whether this might impact on any distributable reserves that the company has at the year end, although we can assist with that sort of thing. There is an option on the accounting treatment, i.e. you don't need to apply this and you can leave the properties at cost if the directors deem the revaluation to involve undue cost or effort. Now, whilst this might seem like a good idea at some point from a cost point of view and not having to have the properties valued each year, it could cause other impacts such as breaching bank covenants if you've held an investment property for a long time and reducing it down to its cost significantly decrease your assets. One of the major changes for investment properties is that now we're going to have to recognise the deferred tax liability. So this would be the tax that would be due if that property was sold at the balance sheet date. Previously, there was only a requirement to do that if you had a binding contract to sell it at the year end. I think in this sort of instance, this is where you're going to need assistance from us in calculating these deferred tax liabilities. And I think that this is something that impacts you, then get in touch as soon as possible. In some instances, you'll be allowed to undertake a one-time revaluation of plants and machinery or fixed assets, investment properties, or any other intangible asset. So you may have a investment property or a tangible fixed asset that had a cost of 100,000 at the year end. It had a book value of £10,000, for example, a piece of plant and machinery. But you know that market value of that, or the fair value, is significantly higher than that, you could choose to do a one-time revaluation to improve your balance sheet. The example we give here is to revalue a property at the transition date. For example, a factory that you were operating out of. If you had previously had a policy to revalue assets, for example, freehold property, then you could abandon this policy at this point and use the revalued amount as a deemed cost. And the second example we give there is over-depreciated plant and machinery could be revalued to fair value just to improve your balance sheet. The next change that I will talk about is in respect of financial instruments. So in FRS 102, these have been split into basic or non-basic financial instruments. Basic financial instruments might be cash, debtors, trade debtors, other debtors, trade creditors, loans, anything that you see on the everyday balance sheet. So basic financial instruments have always been held at cost. So if you have cash, that will be held at the amount shown on the bank statement. If you have trade debtors, for example, they would be shown at the amount that you're expecting to receive from those customers. The key change here is that basic financial instruments will be now measured at amortised cost. Now, for everyday items such as trade debtors and trade creditors, this doesn't really change anything. For creditors that are not due immediately, or debtors that are not due immediately, this could have an impact on profits, as if items are owed in, say, 3 years' time, but no interest is being charged, there could be a one-off adjustment to reduce that down to its current value and account for an effective interest charge over the 3-year period, for example. Now that could increase your profits on the point of transition, then could significantly decrease your profits for the next 3 years. I think if you've got loans that are due in more than 1 year and there's no interest being charged on them, then you need to talk to us, and there may be ways that we can assist you and get around some of these accounting requirements. Non-basic financial instruments are where it gets a bit more interesting, and these would include things like interest rate swaps or foreign exchange forward contracts that you may be using for if you're trading in dollars or euros, for example. Now previously there would have been no requirement under the FRSI to do anything with these. Let's use forward exchange contracts as an example, whereas now there'll be a requirement to account for these at fair value. And what that means is that if you are either making a profit or a loss on those forward exchange contracts at the year end, that you will then have a corresponding adjustment go straight through your profit and loss account. So again, in much the same way as the investment properties did, we could see some significant adjustments and changes in profits or losses, not only in the previous periods, but also in periods going forwards. In some cases, this may be an advantage. It may increase profits, but in other cases, it may decrease profits and may impact on previously declared dividends. Again, if this is something you want to talk about further, I think you need to get in touch. The key thing here is going to be accounting or calculating the fair value at the transition date. And this is something that we will probably need to assist you with, and will again mean that you do need some good records. And I suggest, because there's so many examples we give here, that people contact us with their own specific instances. Some of the other significant changes that have occurred. First one is in grant income. Previously, this would be accounted for on accruals method. So if you were going to receive £100,000 from a government grant and you were going to incur £100,000 of expenditure, you would account for that grant income as you incurred the expenditure. And if you bought a fixed asset with that grant, you would account for the income from the grant as you depreciated that fixed asset. FRS 102 keeps the accruals concept, but also brings in a performance measure of grant income. So if you have a grant income that is dependent on you fulfilling certain criteria, for example, purchasing a property, and that is the only ongoing obligation you have, there is a possibility you could recognise that grant income immediately on receipt of the grant. I think if that's something that may impact on you, you definitely need to talk to us, because there could be tax consequences that need to be considered as well. Biological assets such as horses or bloodstock or crops and other agricultural items like that. Previously, you would just count for these at cost. There is an option to account for these at fair value if you so wish, although you can still continue to account for these at cost. I think that will be quite a sort of specific item. There have been some impacts on defined benefit pension schemes, particularly in relation to finance costs. I don't think there are too many small companies with defined benefit pension schemes, but if there are, then there are some changes there to look at. The last sort of significant change that we've identified is in regards to share-based payments. For share options issued after your transition date, these must be now accounted for at fair value. There's a very complex calculation that you need to go through using what's called a Black-Scholes model. Again, I think this is an area where we can certainly assist you. Previously, under the FRISI, there was only a requirement to disclose certain information about these share-based payments or share option schemes you had in place. Luckily for you, and probably for us, you only need to apply this to share schemes which are implemented after your transition date, so there'll be no retrospective calculating of fair values. There have been some changes in the format and language of the financial statements. Mainly this is to do with the terminology that's being used. So for example, a balance sheet has now become a statement of financial position, and a profit and loss account has now become a statement of income. Luckily for us, you can continue to use the old ones, balance sheet and profit and loss account, if you would like. The accounts will look at slightly more international financial reporting in style, and a lot of that is to do with the terminology. Now, for accounts where there have been changes arising from the implementation of FRS 102, it is the best practice, although there is no requirement to include a reconciliation, to show how you got from your profits previously reported under the FRISI to the profits that you are now reporting under FRS 102. Now, I think if you have sort of other stakeholders that are going to want to understand the implications of these changes, and it's going to be quite key to include that note, although, as I've said, it's not an actual requirement. In terms of accounting policies, I think you're going to find that where accounting policies are in existence, there is slightly more emphasis on giving more information, for example, in revenue recognition or turnover accounting policies. Although, as we talk about in a minute, there are some disclosure exemptions available for small companies. So it leads me nicely on to talk about these exemptions from disclosures. There will be a reduced number of disclosures in the financial statements for a small company following the implementation of FRS 102, and this is all linked from the EU Accounting Directive, which we have to adopt as part of our EU membership. So what we are going to see is a set of small company accounts reduced down to a profit and loss account, a director's report, very much similar to what we currently have, and a balance sheet. Then, at a minimum, there are going to be 11 notes which are mandatory, and not all of them will apply to every company. Some of these notes include details of average number of employees that previously did not need to be disclosed, and also details of related party transactions. There'll be no requirement for a small company to include a cash flow statement in their accounts, which is exactly the same as under the FRISI, and you will also not be required to show a strategic report. Under FRS 102, there's normally a requirement to show a note that shows all of the statement of changes in equity, although this is not required under the small company regime unless it is required to show a true and fair view, but that would really be at the discretion of the directors. Finally, there's going to be the ability to file abridged accounts, but previously you would be able to file abbreviated accounts at Companies House, which would give a balance sheet and a director's report, but this is being removed, and you will have to file much longer accounts limited to these 11 notes that I referred to earlier. This will probably mean it will certainly mean in most cases for small companies there's more information available in the public domain than there has been before. So what's the effect on profits going to be? Potentially you could have faster goodwill amortization, resulting in a decrease in profits. You could end up with more intangibles on acquisitions, which, depending on the period of time you decide to amortize those over, could result in an increase or a decrease. Holiday pay accruals are going to be quite common for a lot of small companies, and these in most instances will decrease your profits, certainly on the point of transition. Lease incentives, which we discussed earlier, these are going to impact on your profits, whether it be a decrease for the first period and then an increase for previous periods. Derivatives, such as the non-basic financial instruments we talked about, could be introducing a fair bit of volatility into your profit and loss account, and not really something that you can forecast either. So we're just going to move briefly on to some of the headline tax implications of the introduction of FRS 102. These changes fall into two categories: those that affect the quantum or timing of the corporate tax charge. So this could be a result on the transition that your profits decrease, and therefore your taxable profits could decrease, resulting in a decrease in tax, or in some cases a repayment due from HMRC. And you could also have items where it pushes out or accelerates the timing of corporate tax payments, although all of these would need to be looked at on their individual merits. There's been some changes to the accounting disclosures, particularly with regards to deferred tax. I think the one example I used earlier was on the investment properties. Now, deferred tax is not real tax that's due at the balance sheet date. It's tax that will be due in the future, in the example of the investment properties. There will also be potentially some extended notes in the financial statements. So just briefly, the tax effect of some of these accounting changes. Lease incentives: if your accounting profits have been decreased by the change in these leasing incentives, then that would decrease your taxable profits, resulting in a decrease in tax that would be due. The same applies really to holiday pay accruals, where the accounting profit will potentially be lower, although you may see some of that benefit start to reverse out in future years, dependent obviously on the level of holidays, the number of staff you employ, and the level of salaries of those individuals. Grant income I mentioned earlier, you could accelerate your profits on this. This could have potentially significant impacts on your corporate tax liabilities, and as I said earlier, if this is something you're thinking of doing, then certainly something that you need to flag up with us so that we can ensure it's appropriately managed. Financial instruments: if you have complicated financial instruments such as forward exchange contracts or interest rate swaps, then please do let us know as soon as possible, because there are certain elections that can be put in place to mitigate against this, any unwanted tax implications from these, but we do need to know about those as soon as possible. Investment properties I mentioned on the previous slide. This is where there'll be, assuming you haven't decided or you haven't disposed of an investment property, that there will be no changes in the current tax due, just changes in the accounting for deferred tax. So the tax accounting changes, these revaluations that you're making, that again is the investment properties, that will impact on deferred tax that's going to be accounted for at the balance sheet date. Again, with business combinations, we may have more deferred tax arising, which could end up being quite complex calculations. And in certain circumstances, there may have to be a tax reconciliation note in the financial statements. Previously, under the FRSI, there was no requirement to have those. we just move on and say a few words about the new micro entities regime. Alex said earlier that there were new thresholds for small companies, the main one being the increase in turnover to 10.2 million. As it had been introduced at the same time, a new threshold for a micro company or micro entity. This turnover is 632,000, a balance sheet total of about 316,000, and no more than 10 employees. So we really are talking about the small companies now, very small companies. This accounting rules are going to be contained in what is known as FRS 105. This is a very simplified version of FRS 102, which basically does away with anything where you need a revaluation, for example, investment properties, or where you have forward exchange contracts. There is no accounting for deferred tax, and there are also no accounting policy choices. There is a strict list of accounting policies that you must follow, and if this is something that impacts on your size of entity, then we can share those details of those accounting policies with you. There's going to be minimal disclosure in these financial statements, even less disclosure than for the small companies. And I think where this may start to impact is on property companies, for example, where they may have historically had a property that they bought for, say, 200,000, and they have minimal turnover from rental income and therefore minimal employees. They may technically qualify as a micro company, but they may choose not to apply that because they would have to hold their property at cost, which could cause issues with bank covenants and things like that. I'm going to now pass you back over to Alex, who's going to run through preparing for the change.
Okay, thanks very much, John. Before we move on to the end of the webinar, we're just going to re-ask the same question, and this time hopefully you've now had a chance to think about some of the changes to your accounts which are going to result from the FRS 102 changes. So after what you've just heard, do you now expect your profits to increase, decrease, or stay the same? We've taken away the don't know this time because hopefully everybody has some idea now as to what might happen to their own accounts. So we'll just have another 10 seconds while people are answering that. I think most of the votes are coming in. Any increases there? I think increasing profits don't seem to be very likely at the moment. Okay, so 59%, nearly 60% of people think that profits will actually decrease as a result of the new rules, and 41% of people think they'll stay the same. And interestingly, no one actually thinks that their profits will increase at all as a result, which is interesting actually, because there are some areas where profits could well increase in the future. Okay, so preparing for the change then, just take a few minutes before we finish to talk about some of the preparation. As we've discussed already, this becomes real for all small companies other than those who are micro entities or want to apply the micro entity rules from the 1st of January next year. Those companies with December year ends will be using these rules for their 31st of December 2016 accounts. And as we've also discussed, some of the changes will mean that information will be needed going back to 2 years before that. So I think the first thing to do is to review the position. Obviously, this is something that we will do with our clients as we talk to you over the next few months as we meet with you. So look at the accounts and see where potential changes may occur. And then once that's been done, there's going to certainly be an information gathering process that's going to be required. In terms of systems and software, I wouldn't expect that to affect most of our clients, certainly where we prepare the financial statements at the year end. We obviously have updated software, and our software will take account of this. And if you're using a package such as Sage or Xero or a similar sort of internal accounting package, I don't think that you're probably going to have significant changes as a result of this. Obviously then, if there are significant changes, I think we'll need to sort of timetable in how this is going to be dealt with and work out whose role and responsibility it is. In terms of actually doing the sort of working out the changes then, I think if we put up this timeline here, this probably best illustrates the process that's going to need to happen. So this, for example, looks at a 31st of March year-end company. So as we've seen already, that company will need to apply the new FRS 102 rules from the 31st of March 2017. The date of transition for that company will be the 1st of April 2015. So if you have certain things in your accounts, for example, you've issued employee share options in the period after the 1st of April 2015, or for example, you've acquired a company and you prepare consolidated accounts and that acquisition's been in that period, then those things will need to be thought about. Things like holiday pay accruals, also you'll need to go back to the 1st of April 2015 and calculate the accrual at that date, and also at the following year, the 31st of March 2016. Okay, in terms of actually doing the accounts then, the comparative period will need to be restated under the new rules. So if you do have changes to your numbers, both the 31st of March 2017 accounts and the 31st of March 2016 accounts will need to be under the new rules. And as John mentioned, it will be good practice to have a reconciliation in the accounts showing the effect of the new rules on your numbers, just so that people can see, users of the accounts can see how they've changed as a result. Okay, so I think we've probably mentioned most of these already. Areas for early consideration then, things like fixed asset values. If you want to take advantage of the deemed fixed asset rules, remember you can have a one-off revaluation of your fixed assets if you want to. Then obviously you're going to need to get valuations or have an idea of the valuation of those assets. Financial instruments, for example, if you have forward exchange contracts, you're going to need to know the value of those contracts at the transition date. So in our example, at the 1st of April 2015, at the 31st of March 2016, and at the 31st of March 2017. So there'll be information that you need to get hold of. Same with things like holiday accruals, as we've talked about. Okay, I think that probably covers what we wanted to talk about today. There's obviously a lot here, and there's a lot more to this than we can cover in a 45-minute webinar. Obviously, we will be talking to our clients about this as we come round and meet with you. All companies will be different. It's very difficult to do a sort of one-size-fits-all piece of information because every single company will be different. If you do have concerns, or you do have some of the areas which we focused on today, then I think it's going to be useful to start as early as possible in terms of where you're going to get the information from. If your profits are likely to reduce as a result and you have things like bank covenants, then it's going to be important to talk to those stakeholders at an early stage and discuss any potential problems. So I think that the message really is to have a plan and to act now. Okay, so thank you very much for listening. We've got a couple of minutes to answer questions if people have questions, and I can see that one question has come in already. So the question that's come in is, when you say use of new terminology is optional, is this optional in the formal financial statements as submitted to Companies House, or only in the management accounts used in-house and submitted to the external accountant? And John's just going to quickly run through that.
Yeah, well, I think the answer to this is yes, that you can submit the you can use the new terminology in the account submitted to Companies House, but you don't have to. And what you do in house is obviously up to you. But no, you don't need to use the new terminology in the Companies House accounts.
There's actually quite a lot more flexibility under the new rules. Up to now, we have been fairly it's been fairly prescriptive in terms of the words you have to use in your financial statements, the order things come in, etc., etc. It's actually going to be far more flexible going forward, both in terms of the words you use in your accounts, i.e. the headings, so whether you call it turnover, for example, or revenue as an alternative, and also the sort of order you put things in and the subheadings that you use in that. So I think the general answer to that is more flexibility rather than less flexibility. Okay, another question's come in. Will you be supplying pro forma accounts in advance? Pro forma accounts is something that we will be able to sort of provide. As I said, all companies will be different, and there's a lot more flexibility, so they won't necessarily suit all people. But where you do prepare your own accounts, if you do need assistance in adapting the format you've got at the moment and having a pro forma going forward, then yes, we can certainly provide that. Okay, so I think that's our time up. We've actually not got any further questions come through. As ever, if you do have questions, then please don't hesitate to contact your usual contact at James Cooper, or alternatively myself or John. Thank you very much.